December 20th, 2025, 4:45 a.m. Eastern Time. While the markets in New York were still sleeping and the algo bots were trading sideways on low volume, a PDF document was quietly uploaded to the servers of the Secretaría de Economía, the Mexican Ministry of Economy. It wasn't a press release, it wasn't a headline on Bloomberg, it was a routine export license modification filing, labeled Expediente 99X2026. Most analysts never look at these filings. They are boring, bureaucratic procedural updates usually reserved for textile quotas or avocado shipments. But buried on page 114, under the subsection labeled Strategic Mineral Offtake Agreements, is a paragraph that effectively ends the silver market as we know it. The filing details a newly signed binding contract between the Mexican federal government, the mining giant Fresnillo plc, and a US-based entity listed as Project Redwood Acquisition Corp. If you dig into the Delaware corporate registry, Project Redwood is a wholly owned subsidiary of Tesla, Inc., and the terms of the contract. It grants Project Redwood exclusive right of first refusal and total offtake authority for 100% of the exportable silver cathode and concentrate produced by Mexico's 3 largest state-licensed mines for the fiscal year 2026. Let me repeat that. So you understand the gravity of what just happened. Tesla hasn't just bought some silver. They haven't just hedged their position. Tesla has just effectively nationalized the entire output of the world's largest silver-producing country for their own private supply chain. The supply chain is dead. The COMEX is a zombie. And in this video, I am going to show you the math that proves why 50 silver is not a target, it is a memory. Hit S. I'm going to break down the silver carbon, battery tech that Elon Musk has been hiding. I'm going to show you why Apple and Samsung are about to panic buy everything that isn't T-bolted down. And I am going to tell you exactly what happens to the spot price when 200 million ounces of supply disappear overnight. This is not speculation. This is an industrial raid. And you are watching the aftermath. Let's start with the numbers, because the mainstream financial media is going to spin this. They're going to tell you it's just a strategic partnership. They're going to say it's bullish for EV adoption. They are missing the forest for the trees. We need to do the math to understand the scale of this theft. According to the Silver Institute's 2024 production data, Mexico is the #1 silver producer in the world. They pull approximately 230 million ounces of silver out of the ground every year. Now, look at the clause 14b in the leaked document. It specifies the exportable yield. After domestic Mexican industrial consumption, which is roughly 20 million ounces, Mexico exports about 210 million ounces annually to the global market. A huge chunk of that usually goes to the LBMA in London and the COMEX in New York to back the futures contracts you trade. Tesla just took all of it. 210 million ounces. Gone. Now, why does Tesla need 210 million ounces? This is where the analysts are getting it wrong. They are still calculating silver demand based on the 2020 era electric vehicles, which used about 20 to 30 grams of silver per car, roughly 1 ounce. If Tesla produces 5 million cars in 2026, that's only 5 million ounces. So why buy 210 million? Is Musk cornering the market? Is he trying to be the new Hunt brothers? No, it's the technology shift that nobody is pricing in. 3 weeks ago, a patent surfaced for Tesla's new 4680S cell. The S stands for sintered silver. This isn't just for conductivity anymore. This is a structural anode component designed to handle the massive amperage of the new Cybercab fleet and the Optimus Gen 4 robots. The patent specs imply that the silver loading per vehicle has jumped from 1 ounce to approximately 8 ounces per vehicle for the high-performance Cybercab. Do the math. 5 million vehicles times 8 ounces per vehicle. That is 40 million ounces just for the cars. But that's not the big number. The big number is the robots. Musk has stated publicly that the Optimus robot production line aims for 2 million units in 2026. Robots are not cars. They are thousands of electrical contacts, servos, sensors, and actuators. A high-end industrial robot contains significantly more silver than an EV. Conservative estimates from teardowns of similar industrial robotics put the silver content at 15 to 20 ounces per unit, due to the need for zero-latency, non-corrosive connections. 2 million robots times 20 ounces per robot. That is 40 million ounces. We are at 80 million ounces of demand just for Tesla's manufacturing. Then you add the solar roof division, which has been quietly ramping up gigafactory production in Nevada. Solar is the single most silver-intensive industry on Earth. Tesla's goal of 500,000 solar roof installs using the new high-efficiency heavy-load panels, another 30 million ounces. We are at 110 million ounces of pure physical demand, but Tesla bought 210 million. Why? Because of the safety stock multiplier. When you're building a trillion-dollar automated ecosystem, you cannot afford a stockout. Just like the U.S. Strategic Petroleum Reserve, Tesla is building a strategic silver reserve. They are buying double what they need because they know what is coming. They know that once the rest of the industry realizes the shortage, the market will freeze. They are buying the haystack so nobody else can find the needle. So 210 million ounces are removed from the global supply. Total global mining supply is roughly 830 million ounces. Tesla just removed 25% of the entire planet's new silver supply in a single signature. The COMEX registered inventory currently sits at roughly 85 million ounces. Tesla's purchase is 2.5 times the size of the entire COMEX registered vault. If you think the price stays at $32 with a hole this big in the supply sheet, you do not understand supply and demand. This is not a squeeze. A squeeze implies pressure that will eventually release. This is an amputation. The limb is gone. Disclaimer, I'm not a financial advisor. This is not financial advice. I am an independent researcher connecting the dots that Wall Street is paid to ignore. Now, let me explain the game theory nightmare that this document triggers for everyone else. Imagine you are the chief procurement officer at Samsung, or Apple, or Sony. You make smartphones, tablets, and laptops. Every single one of those devices requires silver. There is no substitute. You cannot use copper. It oxidizes. You cannot use gold. It's too expensive. You must have silver. For the last 20 years, your job was easy. You called a bullion bank, you placed an order for 10 million ounces at spot price, and it was delivered. The supply was always there. This morning, you woke up, you saw the leak from Mexico, and you realized that 25% of the world Essung supply just became the private property of your biggest competitor in the tech space. What do? You panic. You don't buy what you need for next month. You buy what you need for the next 5 years. You pick up the phone and you call the refineries in Switzerland, Valcambi, Pamp, Argor Heraeus. You tell them, I want everything you have. But here's the problem. Tesla beat you to it. The leak indicates that the agreement with Mexico is effective January 1st, 2026. But the logistics are likely already in motion. The ore that is being mined today is already tagged for Tesla. So Apple calls the refinery. The refinery says, I'm sorry, our allocation for Q1 is spoken for. Apple says, I'll pay $2 over spot. The refinery says, it's not about the price, we don't have the metal. Apple says, I'll pay $10 over spot. This is how the price disconnects. This is how we get the spot price versus real price bifurcation. The COMEX spot price is a paper derivative determined by high-frequency traders swapping contracts that never touch metal. But the real price, the price that Samsung is about to pay Valcambi to keep their factories running, is about to go vertical. We saw a preview of this with the palladium squeeze in 2019 and the nickel squeeze in 2022. But silver is different. Silver is strategic. You can build a car without palladium. You cannot build a modern electronic civilization without silver. And the other tech giants know this. They have just-in-time inventory systems. They run lean. They have maybe 4 to 6 weeks of raw silver inventory. If they think that supply line is threatened, just-in-time becomes just-in-case. They will front-run the market. We are going to see a bidding war, not between speculators on Reddit, but between trillion-dollar market cap corporations who view silver not as an investment but as oxygen. And who is caught in the middle? The banks. JP Morgan, Citibank, HSBC. They are the ones who sold the shorts. They are the ones who leased the silver to the tech companies. They are the ones sitting on the short side of the COMEX with paper liabilities. When Apple demands physical delivery of 50 million ounces to secure their inventory and the banks look at the vault and see it empty, because the Mexican supply they counted on is rerouted to a Tesla gigafactory in Texas, that is a force majeure event. That is the moment the music stops. When this news leaks to the wider media, probably by Monday morning, the gravity will kick in. I want to show you a chart. Look at this divergence. Open interest, the bets, is going up. Registered inventory, the collateral, is hitting 30-year lows. Now subtract the Mexican supply from the inflows. The line for inventory doesn't just go down. It goes vertical. It goes negative. This is a mathematical impossibility. You cannot have negative inventory. The only variable that can resolve this equation is price. The price has to rise to a level where people sell their grandmother incest silverware to feed the Tesla factories. What is that price? Is it $50? $100? In 1980, adjusted for inflation, silver hit $140. And that was just financial speculation by two brothers from Texas. That wasn't an industrial necessity for the entire energy transition. We are looking at numbers that don't make sense to the normal mind because we have been conditioned by 40 years of suppression. Why should we believe this leak? Why is it credible? Because Tesla has done it before. Look at what they did with lithium. In 2022, when lithium prices spiked, Elon Musk didn't just buy lithium. He bought the refining capacity. He built a lithium refinery in Corpus Christi. He secured offtake agreements directly with miners in Australia and Chile. He vertically integrates. He hates reliance on third-party suppliers. He looked at the silver market. He saw a small, manipulated, undersupplied market that is critical to his success. He saw that the banking cartel was keeping the price artificially low. And he said, "Thank you." He used the suppressed price to lock in a long-term contract at favorable rates. The banks, in their arrogance, probably helped him structure the deal, thinking they could keep playing their paper games. They didn't realize they were selling him the rope to hang them with. This filing, Expediente 99-X-2026, is the receipt for that rope. And notice the date of the leak, December 20th, just before the end-of-year book closing. This means the silver is booked for 2026. Supply shock hits on January 1st. We are 11 days away from the start of the first year in history where the world's largest consumer consumes the world's largest producer entirely. The other automakers are asleep at the wheel. Ford, GM, Toyota, they are still buying silver on the spot market. They are still relying on their Tier 1 suppliers to source it. When those Tier 1 suppliers call Mexico in January and hear "no tengo plata," the assembly lines in Detroit and Japan will stop. You think the chip shortage was bad? You can print chips if you build a fab. You cannot print silver. It takes 10 years to bring a new mine online. Tesla just bought the bridge. Everyone else has to swim. So where does that leave us right now, in this specific moment? We have a leaked document that confirms the removal of 25% of global supply. We have a hidden technology shift, silver carbon batteries, that explains the massive volume. We have a national security clause that implies government backing and geopolitical conflict. And we have a paper market that is completely oblivious. Let's talk about the specific mechanics of how the COMEX, commodity exchange, dies because of this deal. The COMEX works on a system of authorized participants and approved brands. Fresnillo is a major approved brand. But under the terms of the leaked Tesla agreement, Fresnillo bars are now the property of Project Redwood. They are being shipped directly from the refinery in Torreon to the Gigafactory in Austin, Texas. They are not crossing the ocean to London. They are not going to the New York vaults. The flow of fresh metal into the COMEX ecosystem stops. But the outflow continues. Investors are still demanding delivery. Industrial users are still withdrawing metal. Imagine a bathtub. The drain is open, demand. The faucet was just turned off, Mexican supply. How long until the tub is empty? Currently, the COMEX has roughly 85 million ounces in registered, deliverable inventory. The monthly withdrawal rate, even before this panic, has been averaging about 15 to 20 million ounces. With the supply cut, that withdrawal rate will likely double as panic sets in. Let's be conservative. Let's say 30 million ounces a month are pulled out by panicked industrial users. Month 1, January. 85 million, 30 million, 55 million left. Month 2, February. 55 million, 30 million, there's 25 million left. Month 3, March, 25 million, 30 million, now negative 5 million. Default. By March 2026, less than 90 days from now, the COMEX will mathematically run out of silver. But markets anticipate. They don't wait for zero. They panic before zero. When the inventory drops below 30 million ounces, the psychological red line, the run on the bank begins. This is exactly what happened to the London gold pool in 1968. The nations tried to suppress the price of gold. The market realized they were running out of metal. The buying accelerated. The pool collapsed overnight, and the price of gold exploded. We are watching the London silver pool collapse in slow motion, and Tesla just pulled the plug. We touched on the national security clause, but we need to go deeper into the geopolitical fallout. This is where it gets dangerous. China has been systematically cornering the market on green energy metals. They control the cobalt in Congo. They control the lithium refining. They control the rare earths. Silver was the one metal where they were vulnerable. They are a net importer. By locking up Mexican silver for North American energy security, the US and Tesla have essentially declared a resource war on China's solar dominance. China cannot let this stand. The Chinese Communist Party, CCP, plans in decades, not quarters. They have strategic reserves. My sources in Shanghai tell me that the Shanghai Gold Exchange, SGE, has been draining silver from the West for the last 18 months via arbitrage. When this Tesla news hits Beijing, the response will be swift. I predict that within 2 weeks of this filing becoming public, China will announce a strategic resource protection policy. They will ban the export of all silver, including silver contained in finished products like batteries and electronics, unless it is for a friendly nation. This bifurcates the world. The Western Bloc, North America to Europe, fighting for scraps of South American production. The Eastern Bloc, China, Russia, India, hoarding their own production. Global trade relies on fluidity. When you erect walls around commodities, efficiency dies and prices soar. If you are a solar installer in Germany and you can't get Mexican silver, Tesla took it, and you can't get Chinese panels, export ban, you are out of business. Unless silver goes to $100 an ounce, making it profitable to recycle old electronics, melt down grandma's tea set, and mine marginal deposits. Price is the only solution. The current price of $30 assumes a global, frictionless trade environment. That environment died this morning with Expediente 99X 2026. So how does this play out for us? Let's look at the timeline. I've gamed this out based on how markets react to liquidity shocks. Phase 1, the leak and the denial. Right now, next 24 hours. The document circulates on private forums like this video. The mainstream media ignores it or calls it unverified. The banks try to cap the price to prevent a blowout while they cover their shorts. Price action, volatile. Sharp spikes followed by massive slam downs as JP Morgan dumps paper contracts to paint the tape. This is a trap. Do not be shaken out. Phase 2, the confirmation to Monday, Tuesday. Bloomberg or Reuters picks up the story. Tesla issues a vague statement confirming supply chain hardening measures. The industrial buyers, Samsung, Sony, start hitting the buy button on the physical wholesale market. Price action. Spot price moves to $38, but the physical premium jumps. You try to buy an American Silver Eagle, the premium goes from $10 to $20. Phase 3, the inventory drain, January 2026. The monthly inventory reports come out. We see the massive drawdowns. The registered category on comics plummets. The media narrative shifts from inflation to shortage. We start seeing headlines like silver, the new oil. Price action, $45, $50. We break the all-time highs. The psychological barrier creates a FOMO frenzy. Retail investors flood in. Phase 4, the force majeure. February, March 2026. A major bullion bank or a large mint declares force majeure. They cancel orders. They settle cash instead of metal. They send you a check for your unallocated silver instead of the silver itself. This breaks the trust in the paper system. Price action. The paper price might actually freeze or be suspended. The physical price becomes a black market auction. $80, $100, no offer. This is the nickel scenario from 2022. The LME canceled trades when nickel exploded. They will change the rules to save the banks. They will close the casino. If you are holding SLV, the ETF, you are holding a promise that will be broken. If you are holding physical metal in your hand, you are holding the only asset that matters. I cannot stress this enough. The spot price is a lie. Right now, you can go to a website and see silver at, let's say, $32. But go try to buy a monster box of Eagles. The dealer will charge you $45 per ounce. That $13 difference, that is the reality gap. As the Tesla shock moves through the system, that gap will widen. Spot might be $40, but physical will be $70. Spot might be $50, but physical will be sold out. We are moving into a market where availability is more important than price. It doesn't matter if silver is $100 an ounce if you can't find any to buy. Tesla has ensured availability for themselves. They paid the price, likely billions in guaranteed contracts. You don't have billions. You can't sign an offtake agreement with a mine. You have to fight for what is left on the retail shelf. And the inventory on those shelves is thin. The U.S. Mint has been on allocation for months. The Royal Canadian Mint is diverting production. The secondary market, people selling back to dealers, has dried up because nobody wants to sell a hard asset for a devaluing currency. When the Tesla news goes viral, the remaining retail inventory will be wiped out in 48 hours. I have seen this happen in March 2020. I saw it in January 2021 during the silver squeeze. But this is different. Those were sentiment events. This is a structural supply event. Sentiment passes. Supply shocks last for years. So what do? You have a window, a very small closing window. It is Saturday, December 20th. The markets are closed. The dealers haven't updated their algorithm pricing yet. The Tesla premium hasn't been priced in. You have 72 hours. By Monday morning, the Asian markets open. They will react first. By Tuesday, the US markets will digest the news. If you have cash on the sidelines, waiting for a dip, the dip isn't coming. The dip was the last 3 years of suppression. That was the gift. The gift horse just died. Step 1, secure physical metal immediately. Focus on sovereign coins, eagles, maples, or recognized bars. Avoid obscure collectibles. You want liquidity. Step 2, if you cannot get physical, look at the miners. If silver goes to $50, the miners, especially those with production outside of Mexico, since Mexico is now locked up, will print money. Look at miners in Peru and Canada in safe jurisdictions. Step 3, get out of the banking system's paper silver. Sell your SLV. Sell your unallocated accounts. If you can't touch it, you don't own it. Tesla understands this. That's why they took delivery. Learn from the richest man in the world. History is being written this weekend. In 10 years, people will look back at Expediente 99 x 2026 as the moment the silver market changed forever. They will talk about the Tesla shock. They will ask, why didn't anyone see it coming? But you saw it coming. You're watching this video. You have the buried data. The math doesn't lie. 210 million ounces gone. Inventory at zero. Industrial panic loading. The train is leaving the station. You're either on it or you're under it. Don't be under it. This is the Bullion Watch. I'll see you on the other side of the repricing. Subscribe. I want to take you back to page 114 of the document, because there's a phrase in clause 14b that stands out significantly. The text is in Spanish. Considerado como material de seguridad energética norteamericana. Translation: considered as material for North American energy security. This is the critical indicator. This suggests that government-level planning is involved. This isn't just a corporate deal. This appears to be a coordinated effort to secure critical resources. Why does that matter? Because it applies a strategic priority logic across borders. It essentially creates a secured zone for critical minerals within North America. It means that silver produced in Mexico is now potentially prioritized for North American entities over international ones. Who are the international entities? Major global manufacturers, particularly in Asia. China imports significant amounts of silver concentrate from Mexico to support its solar panel industry. With China producing a vast majority of the world's solar panels, they rely on this supply chain. This offtake agreement represents a major shift in trade dynamics. It effectively redirects a primary supply source. Do you think major global producers will just accept that? Do you think they will simply stop production? No, they are likely to respond. And their response could be to secure their own domestic silver production. China is the number 3 silver producer in the world. If they respond to this deal by restricting silver exports, a move that has been debated for years, then another 100+ million ounces leaves the global market. Let's recount the potential impact. Mexico's 210 million ounces, secured by the new contract. China's 110 million ounces, potentially restricted for domestic use. Russia's 40 million ounces, already limited by sanctions. That is nearly 50% of the global silver supply potentially removed from the open market. And yet, you look at your screen, and the spot price is down 15 cents today. The algorithms are trading the DXY dollar index. They are trading inflation expectations. They are trading market noise. They are not trading the physical reality that the available inventory is depleting rapidly. This disconnect is your opportunity. This is the brief window of time, maybe 48 hours, maybe 72, where the paper price has not yet realized that the physical assets backing it have been reallocated. Let me explain why the price hasn't moved yet. It's important you understand the mechanics of this divergence. The silver market is 2 markets. Market A is the physical market. This is miners, refiners, and industrial users. It deals in actual 1,000-ounce bars. Market B is the paper market. This includes the major exchanges. It deals in futures contracts and unallocated accounts. The paper market is significantly larger than the physical market. For every ounce of real silver in a vault, there are many paper claims held by investors. Usually, the paper market influences the price. But that mechanism only works as long as the physical users can access the metal they need. The moment a major buyer bypasses the exchange and buys directly from the mine, the link weakens. The exchange price becomes less reflective of the physical reality. If a buyer pays $50 an ounce direct to mine, while the exchange trades at $30, what is the real value of silver? It's $50. But your brokerage account might still show $30 until the arbitrage corrects, until the trader tries to stand for delivery and the vault manager cannot fulfill the order. Then the paper price corrects rapidly to match the physical reality. We are currently in a moment of suspended animation. The market fundamentals have shifted drastically, but the price action hasn't caught up yet.